Quantitative rules-based money management. You're probably asking, what is that and why would I want to use it? That's a fair question, so let's dig in. The first stock market is believed to have started in the early 17th century in Amsterdam. After more than 200 years of trading stocks, the one thing we've learned for certain is that humans are emotional. And when emotions make their way into the investment process, the outcomes are rarely good. There are few things in life more emotional than making and losing money. Those that keep their head during times of stress making decisions just based on the data generally outperform. In reality, we're all quant-based money managers. We have rules that we've developed through the years. Some strategies are more complex and some can be quite simple. However, all too often, our emotions muddy up the data, forcing us to break those time-tested rules. The beauty of turning over some of the duties of security selection to computers is that they're not emotional and won't break the rules unless you've told them to. In fundamental multi-factor quant investing, computers are used to scan a universe of securities and identify those that meet certain parameters. We can rank the universe from top to bottom, those with the best scores to those least desirable. Let's start off with some of the basics. A typical stock in the S&P 500 has hundreds of data points. Some are fundamental factors based on company financials, and others might be technical based on price. Most investors have a process and select factors or data points they prefer that meet their investment style. The value manager might prefer free cash flow yield or price-earnings ratio, while the growth manager might look to estimate revisions, price target change, or revenue growth. The tactical fund manager would likely focus on price momentum, hoping to identify trends both up and down or overbought and oversold conditions. In the end, you can use as many or as few of these factors as you wish and weight them as to the importance in your model. Remember, complexity doesn't necessarily make it better. Next comes the testing phase, looking to discover how your model performed through various market cycles. And finally, you'll want to build in safeguards, perhaps limiting position size and how much could go into any one sector. How volatile is the security? And most of all, how much ability does the company have to navigate economically challenged times? Let's go through the process and build a fundamentally driven, quant-based stock portfolio. Alpha Select is a rules-based quantitative portfolio system mostly focused on large-cap U.S. stocks, predominantly in the S&P 500. However, exceptions are often made, including the use of some exchange-traded funds or ETFs that might be used to quickly enter a sector or industry. Just like I outlined earlier, the securities are ranked from top to bottom. And as the portfolio manager, I make an effort to own securities in the top 10% of the model, eliminating them if they fall below a specified ranking. Other exit points could be used as well. Partial profits might be taken if the security moves higher, especially if its weighting in the portfolio has increased in size relative to the other positions. The same holds true on the downside. A discretionary or rules-based decision could be made if the security falls too far, regardless of its rank in the model. Since turnover in Alpha Select is relatively high compared to other strategies, it's probably best suited for qualified or retirement accounts. Factor investing can be very tedious work, as the manager meticulously backtests one factor at a time across a universe of securities. When you've identified factors that on their own appear to select stocks that can outperform through the various market cycles, we bucket them together according to style. As an example, a value bucket might contain several factors, including free cash flow yield, earnings yield, enterprise value to EBITDA, etc. My revision bucket could include earnings estimate revisions for the quarter, the year, over different time periods, 1 week, 4 weeks, or quarterly. The backtesting of these combinations is again a meticulous, time-consuming process. And all of this needs to be completed before going on to the next stage. Once we've got our buckets, we're probably sitting on 40 to 50 factors each with a purpose of identifying stocks that have passed a rigorous screening, looking to identify securities that will outperform the market in aggregate. A full fundamental quant model might contain value, revision, growth, and quality buckets, but there are no limits here. Some managers might choose to add a bucket of factors focused on price momentum and trends. The portfolio manager is going to have to experiment with different weightings to see what gets the best results across a wide range of market cycles. Let me make this point. You are not constrained and can make mid-course corrections along the way. The value and quality buckets might be increased during times of market stress. The growth and revision buckets could be increased during explosive bull market cycles. There's even a common sense and experience factor here as well. Just because you have good tools doesn't mean you're going to build a great house. The final stage is stress testing. Special forces call it selection and others call it Hell Week. Whatever term you want to use, you're going to have to subject this model to some of the worst market conditions over the last half century. What happens to the model during times of aggressive Fed tightening? How about a financial or banking crisis? You basically want to expose any cracks in the system and make tweaks to minimize the damage. Let's look at an example. Equity managers tend to ignore the balance sheet during low interest rate cycles. Money's cheap, and even the most challenged company can get access to credit or issue debt at favorable rates. When rates rise, it starts to get real. Cracks start to develop, especially in companies with high debt loads. This is an example of a mid-course adjustment that just comes from experience through different market cycles. No system is so perfect it doesn't need human oversight. There will come a time when the portfolio manager has to take over. Remember, we're using tools, and sometimes tools break down or are hit with a new set of circumstances not seen before. Today, some modern airliners are so sophisticated they can land themselves. The pilot is really a systems engineer. For the majority of the flight, the plane is on autopilot with the flight crew just monitoring the systems, making sure the plane is on course but always ready to take over in the event of a malfunction. Today's quant money manager has to think of his or her role in the same way. There will come a time when the manager has to take the controls. The elimination of a security. The model ranks very high because the due diligence of the manager exposes a flaw the system can't see. In the end, these models are living, breathing projects that have to be adjusted and rewritten over time. Markets and economies change, and good managers must be ready to change to meet a new set of challenges. Remember, all of the above is a process. Every great investor has one. You can bet Warren Buffett, even though he doesn't use tools like mine, has a process. Perhaps if Warren was born today, this might be the path he would choose. The point is, investing requires structure, and a quantitative rules-based strategy can help provide it. Anything that can help reduce or eliminate emotion from the decision-making process can help you achieve better, more consistent returns. The future holds a lot of promise. Artificial intelligence and large language models will likely dominate the next phase. I hope you enjoyed today's introduction and will reach out to learn more. Thanks for joining. I'm David Nelson.